Let's start off with all the economic data that we've been seeing coming through, and it's really been assisting the equity markets. It's going to be interesting to see what will come from China tomorrow. GDP is expected to hit 11.5%. A lot of concerns that we're seeing this market overheating. Do you think that it is something we should be keeping an eye out for? Well,
you just kind of wish that earnings will start sustaining the markets rather than just economic data. But you're hoping that the economic data will somehow substantiate earnings data, being higher in 6 and 12 months from now. And that's really what the market is pricing in at this stage. I mean, I think the big thing that you must take into consideration is the gap between, the price you're paying for the earnings you're getting is actually very, very high at this stage. And the risk is that you've got, when you've just mentioned Greece, and you've got it not only being an issue in Greece, as far as sovereign debt is concerned, but you've got it to a similar degree in the US, and then you've got similar issues happening, through Portugal, in Ireland, and other countries as well. You've got those kind of issues that are playing into investor confidence, and that could very easily make the market sell down from these levels, to a certain degree.
So you're expecting some kind of correction?
Well, Cobie? I'm not saying I'm expecting some correction. I'm saying you could potentially see something like that. I mean, look at the Greek issue that you saw yesterday. Short-dated bonds get issued. They have to issue them at 4.85%. Now, just to give you an indication, that's what you're paying for mortgage-backed securities in the US at the moment. So if you want to invest in mortgage-backed securities, you're getting it at 4.85%. And if you're buying treasuries in the US, we're obviously getting a yield that's far lower than that. You're sitting at about 2%, as far as those yields are concerned. Because obviously they're related to the cash rate, which mortgage-backed securities are as well, but you're paying for inherent risk for being in those. Now, that's exactly the situation that you've got in Greece at this stage. They have to go and raise capital and then pay out at 4.85% at this stage, predominantly because of the risk that's associated with it.
And of course, they've got to lure in the investor and convince them as to why they shouldn't go for emerging markets, because most emerging markets are offering that yield. We're also offering growth, and of course, we're offering a whole lot more than what we've been seeing coming through from Eastern Europe.
Yeah, I mean, if you look at the emerging market space, and you may look at the Chinese space, you're often buying there and across emerging markets, you're buying robust economic growth at this stage. You're not necessarily buying earnings yet, but you're buying robust economic growth at this stage. Whereas if you're investing in some of the more shaky kind of G7 type markets, obviously excluding China and so on, you're sitting potentially in a situation where you're buying sovereign debt that could potentially default, and you potentially have to get a restructure. And that's why the whole Greece situation is so interesting to watch, because there's a loan that they might want to incur as well, where they're looking at the rest of the Eurozone potentially paying for that loan. And the whole question is, will they activate that or won't they activate that at this stage?
Cobie, looking at China again, 3% inflation is what a lot of investors are going to be looking for tomorrow. And there are a lot of concerns, because that just means that inflation is going to become an issue. And we know that that is, in fact, the Chinese government's target, 3% for 2010. So if it's hit right now, we might see interest rates being hiked in China. And we talked about this overheating, 11.5% in the first quarter of 2010. So property prices also rising quite significantly in China. If we do see a monetary policy stance being changed in China, do you think that we could see a little bit of a sell-off on the commodity picture? And of course, commodities have run quite significantly.
You could potentially see something like it, but that's probably another 12 months off if you look at the data at the moment. I mean, look at the Chinese situation. The Chinese situation is interesting to watch as well, because you've got this massive economic growth, which has really been stimulated by the authorities. It has, you have some form of consumer spending in China, but they're trying to activate that in order for that to take off and become the prominent growth, stimulator for GDP. And then whilst they're stimulating the economy, you've got inflation taking off, but they're not prepared to stop GDP growth, because they've got major social issues that they're trying to address, and that's why they're trying to do many other things rather than just hiking rates and so on. Obviously hiking rates is one of the tools that they can use, and the question is, what does that economy look like in 12 months from now? Because if they have to stop this, obviously commodities could potentially sell down from that. But that that's not something that you should be worrying about right now. I think those are more kind of 12 months out, those kind of issues.
Okay, 29,000, above 29,000 is where we're seeing the all share, Cobie, and I know you're one of the people that think you should always be investing for the long term. At these levels, would you be accumulating stocks at these levels?
Well, look, we took a policy decision about a month ago. Through the crash, going back to March last year, we were upweighting equities quite easily, and we kept on upweighting upweighted position until about this year, and now we've gone back to what we call a neutral position as far as equities are concerned. And that is not necessarily meaning that we're out of equities. It just means that we're not taking a view on the asset class as yet. Because if you look at it from a valuation perspective, it is actually quite expensive. It's actually more expensive than you can get internationally for equities at this stage. So therefore, being at a neutral space at this stage gives us the opportunity that should some sovereign issue come back into play and the market sells down by 10-15%, it gives us the ability to go and overweight equities from those levels again. And that's really the situation that we're in at this stage. I mean, if you're going to be buying equities at this stage, you're buying local companies with very high multiples. But if you're buying, the only thing that you potentially could be buying is you could be buying the big rand hedges because the currency is so strong, and at some point the currency should blow out and go settle at a higher level than where it is at this stage.
Why is there this expectation that the rand will blow out? It's quite interesting. We keep talking about a rand that is weaker, but in fact the rand has shown quite a lot of strength over the last few years, even though when it does get weak, it gets under pressure. If emerging markets are going to be the big focal point for the global economy going forward, then surely that just means that we'll see a stronger rand from these levels, or a rand that is going to maintain below 10 rand to the dollar.
Look, unfortunately, when you talk about the rand, its reputation precedes itself, So if you go back in time and you go to actually have a look at how it's traded over time, it has this ability to be very, very volatile. And that's predominantly because we are at the whim of international investors who place money in the country and can take it out again. The proverbial hot money that we talk about in the South African economy. So if you take all this into consideration, people are in this country because of yield at this stage. So in the cash market, you're earning about 7%, or you can go buy some Greek bonds at 4.85 and take on the sovereign risk. Alternatively, you can come in the South African market and you can go and put your money in cash, and you could earn yourself your 7 or your 6.5 or whatever rate you could potentially tie in. And that says something about the rest of the environment. You can go buy bonds in this country and get 8.5, 9, and those are sovereign bonds with no liquidity problems. Now that gives you an indication why the currency is as strong as it is at this stage. Now at some point, it can't continue like this. When they start putting up rates internationally, you're probably going to find that the currency will start moving out again. But again, a picture like that is probably only about 12 or 24 months out. It's probably not something that you should be worrying about right now.